Hi, this is Harish here with Root Vision, Mahesh, and Raghav, and we welcome you to the third episode of the Dogs of the Wall Street podcast, Bonds and Fixed Income Securities.
We call ourselves the Dogs because we look out for your investment efforts and we are loyal to our listeners.
And contrary to the name, which is just a nod to the Wall Street of our home country, India, we will mostly be discussing American markets on the show.
We will be your best friends when it comes to investing during a pandemic, and we're here to help you learn the basics of finance, capital markets, and applied economics. Over the next few episodes, we will be discussing different types of securities ranging from fixed income securities like bonds, stock derivatives like options and futures, and more.
All right, so let's just jump right into what a fixed income security is and in theory, how do they work? So fixed income securities and bonds are usually interpreted as IOUs that are tradable. A bond is as good as the issuer of the debt's word. A bond is just a tradable share of debt, if that's a good way to put it. And that's why people talk about, and the reason why people talk about the risk-free rate is when discussing the beta of stocks, they're talking about the U.S. government treasury bonds, which have yet to ever default. They're seen as the safest rate around. So there are several different types of fixed income securities, and the most basic and commonly referred to is a coupon bond. It's called a coupon bond because when you would buy this IOU, it would have coupon strips attached at the bottom that you would cut and redeem for payment. A coupon bond is one that pays a constant rate of interest that is decided at the time of purchase. This bond is paid back in full at maturity after X time of interest payment. The other common fixed income security is an annuity. This would be something like a mortgage. So, can you guys explain how an annuity as a house mortgage, right? How is that similar to a bond, and I guess how does that differentiate from a bond? I'll start you guys off here. So, an annuity is a little bit different from a bond because at the end there is no one payment, like no lump sum payment at the end.
Right.
Rather, it's paid off in installments. So, is that a better structuring? Let's think of it if you were a company. Is that a better structuring for you as a company, or for your balance sheet, would a bond look better?
Well, let's say I think a bond would definitely be more risk, because if you were to pay the lump sum amount of money at the let's say the end of the maturity rate, the company could have gone bankrupt by then, so that would have been upsetting investors. With an annuity, the lump sum payment is paid in installments instead, so even if the company doesn't go bankrupt, you still made some of your money back.
Right. With the bond, you have the risk of the company defaulting on the bond and not being able to pay that entire lump sum at the end. I think with a mortgage, if you're paying, I like to think of a bond as kind of a reverse loan, except there is no, like you said, there is no installment. There's only an interest payment. So you do get that interest payment, which is some level of security that you have. Yeah. Right. Yeah. But you don't get that monthly installment like you would with a mortgage.
Mm. Well, I'd say for a company, if I was running a company, I'd rather issue a bond, and the reason why is because it makes your balance sheet a lot cleaner. You know when you're paying it off, right? If you say that this IOU is timed for 10 years, then yeah, you know that you're paying it off in 10 years. For governments, I think it doesn't make that much of a difference. Like the British government, for example, they issue consols, which is a perpetuity. It's the same thing as an annuity, but it's not on borrowed time. So rather, they just keep paying. They just keep on paying interest, and it never stops. So it's similar as in that it doesn't have a lump sum payment. It just keeps on paying interest. And I guess as a government, it doesn't make a difference. But as a company, I'd like to have that expectation and know that, like, okay, yes, I will be paying it off in 10 years. And I only have to pay interest until then, and I'll make sure that I have the money to pay at the end. Because let's say you're like a startup, then you might not have enough money to take on an annuity type loan. I think you'd be a lot better off going with a bond there.
True. Yeah, I think with government bonds especially, the risk is almost like zero. You're pretty much guaranteed to get your payment, and it looks better. So yeah.
Yeah, like Root just said, it's what's called the RiskFree Rate, because the U.S. government's pretty much never gonna collapse. You're always gonna be guaranteed that money that you paid.
So basically,
yeah, I hope so.
Economic stability and the size of the company depends on if they're going to pay back that bond or not. And if a corporation is generally bigger, the bond is more secure than, let's say, a startup.
Because they have more cash reserves.
Yeah.
So even if economic hardship, they can keep themselves afloat.
Yeah. Another thing I just wanted to bring up is that where the risk-free rate is actually applied, there's something, this is a little bit off topic, but there's something called a Sharpe ratio, which is your returns minus this risk-free rate that we've been talking about, which is usually like the interest payment for a bond from the government for it's usually 10 years. So they when calculating expected returns, people usually subtract the risk-free rate because you're pretty much guaranteed to get that money. And so that's just an example of where it's applied.
Yeah. It's also used in the formula for beta, and that determines the company's volatility. It compares them against the U.S. Government returns. I think it's the risk-free rate plus plus the, hold on, let me pull it up right here. All right, so the formula for beta, which is another place where the risk-free rate is interpreted, it's the beta for your investment is equal to the expected return from your investment minus the risk-free rate over the expected return from the market minus the risk-free rate. And then beta is obviously used in the capital asset pricing model, which is used for the cost of equity when you measure WACC. So as you can see, I mean, when people want to invest, they constantly use this risk-free rate of return to compare their initial investment to. So for CAPM, the formula is the risk-free rate plus the beta times the return on market minus the risk-free rate. And again, it's basically just comparing, like, okay, how good is this investment compared to if I just got something that had carried no risk. And that's a way that a lot of investors actually weigh their portfolios and compare stocks to each other and seeing how risky they are compared to each other. So the U.S. federal government bonds are sort of like a baseline, which is why I think you very rarely see these modern investors invest in these, because they don't have as much upside, obviously, but they're the safest thing out there. And I guess everyone likes to take on a certain amount of risk when they invest, right? I mean, nobody takes on zero risk when they do anything. When you go out in your car, you're taking a risk just by doing that. So, all right. And another kind of bond, I'll just explain this one really quickly, but it's called a discount bond. And this is a bond with an implicit interest rate. So you buy a 4% discount bond at $96, then you'd get $2 in 6 months and another $2 after 12 months if it was, like, let's say a 1 year, right? And then that would be a total of $100. So yeah, this has an implicit interest rate because it gets bought back at 100 and you buy it at 96. So rather than giving you payments, it just buys it for whoever issued the bond. They buy it back for more than you bought it for. So yeah, that's just one other kind of bond that's very simple to understand. This is why the Federal Reserve issued these strips. These are discount bonds that are very simple to understand, and they have implicit interest rates. So yeah, it just makes everything a lot easier. And you notice how I said that you'd get $2 in the first 6 months and another $2 after 12 months? This is because bonds usually pay semi-annually. This is just common practice. Fixed income securities, obviously they're very, very safe, right? That's the whole selling point of them. But bond prices, just like stock prices, they're still prone to market risk. So bond prices do fluctuate. You're not safe from market risk. You're also not safe from default risk, obviously. But bond prices, the only reason that they're safe is because it's fixed income, right? So you always know how much to expect. But bond prices, just like these stock prices to some degree, are inverse to the rate of interest. So if interest rates are low, bond prices will be higher and the yield percentage interest payment will be lower. So the lower the price of the bond, the higher your yield percentage is. Now, anybody can issue this sort of debt. The government can issue it, companies can issue it, municipalities can issue it. Banks, frequently, they turn your mortgage, your car payments, any type of loan that you have, they turn it into debt, and they sell that as well. So, yeah, I mean, anybody can issue this kind of debt. And the more risky bonds are considered like maybe C-grade corporate bonds. They have higher yields, so percentage-wise, they pay more interest, but they also have a higher rate of default. And usually, the long-term ones, they carry a lot of interest rates on them because companies don't last like more than 30, 40 years max, right? So especially if it's a younger company, there might be a lot of competition. They might go bankrupt because of the economic cycles that dictate that we'll have a recession every 10 years. A lot of these companies go under during that time. So that's why the rates are usually way higher. They're like 4 or 5% compared to the U.S. Government bonds, which are like 2.5%. So
So, since you're talking about risk, I want to just pop the question out there.
mhm.
What risk do you think is the worst to incur when dealing with bonds, like interest rate risk, callback risk, default risk, or inflation risk?
Oh, well, I think it's very obviously default risk, right? That's the lump sum payment that you sort of look forward to at the end of the day. And there's that. And I'd say another big risk for your interest payments is the inflation risk. That's one thing that people don't factor in because these are fixed income securities. So while stocks grow with inflation, bonds don't, unless you get an inflation index security, which is a special type of bond.
Yeah, and the inflation component especially becomes prevalent when you're taking out a longer term bond because inflation will go up and you're still getting the same interest payments regardless of the value of the US dollar.
Yeah.
So, yeah.
And I was going to talk about this later, but I guess I'll just say it now. To compensate for that, the US does issue these bonds that compensate for inflation. So after inflation, it'll guarantee an extra percentage on top of that principal amount. They are called ILBs, inflation-linked bonds.
Yeah, so Raghav, do you want to talk about callable risk? I think that's something that some investors might be interested in.
Yeah. So, hold on, let me pull it up. So, call risk is pretty simple to understand. When bond issuers can purchase or retire outstanding bonds from holders, it's usually done when interest rates fall, so they can sell it back at a profit. Um, this is dangerous because, like, you obviously don't want to have your bond called back. You lose like whatever remaining interest you could have been paid and um your lump sum payment also.
So, um, so these C grade bonds that I was talking about, right? Frequently these institutions they'll put the C grade bonds together with AAA bonds, and they'll pull them in with and they put them into these organized baskets called tranches to diversify into riskier debt that can provide higher returns. So yeah, I mean, because like I said, the higher risk bonds they obviously provide a better return, right? So they would pull like for example in the 2008 crisis, they would pull together really bad mortgages together with like AAA mortgages, and that resulted in this really big pricing efficiency because these C grade mortgages were rated as AAA and these AAA mortgages were rated as C grade. So if you were in 2008, that would be a great time to buy like a grade bond because they were being they looked a lot worse than they were because they were in these tranches, and the bad bonds they were overpriced, I guess, and they were advertised as safe even though they actually weren't because they're put into these tranches. And yeah, that mispricing actually caused the 2008 crisis, which was mostly believed to have been caused by institutions, at least in the United States. Obviously, it was a global thing. But yeah, so these corporations they provide bonds to write off to have the tax benefit of writing off the interest payments, and they also don't give up the ownership of the company. Like when you give up equity, right, you're giving up the part of the company. When you're giving out a bond, it's a loan. So yeah, these corporations they issue bonds so that they don't have to necessarily meet the growth expectations that investors hold to them, and they can also finance themselves in a very similar manner. Obviously, you can't rely all on bonds or all on equity because that can mess up your capital structure, and we can explain that later. But yeah, so that's just an idea of why corporates issue bonds. So, do you guys think that issuing bonds even helps investors, or are they only for the benefit of the corporations issuing them and the big lenders that can take on them?
So yeah, I have an answer to that question. Bonds are secure. Like that's fixed income security. They're really risk, almost like really low risk type of investment. But like I said, it's not gonna be a lucrative deal unless you buy a lot of them. Like, okay, so if a corporation is doing really well, you'll still only get paid your interest and still only get paid that lump sum amount of money. Whereas if you had the stock of that corporation, then you would be making profits out of this world. Likewise, if a company is doing bad and you have the bond, as long as they don't go bankrupt, you'd still be getting paid your interest and you'd still be getting paid your lump sum amount of money after the maturity. But if you had the stock of that company, you would be losing a lot of money. So I think,
Yeah, but
yeah.
yeah, that's a
think-
trade-off though, right? With any investment, you go low risk, you should be expecting low returns on that investment. It's bonds, you pretty much have, even in company bonds, they're technically like higher risk than government bonds, but they're still low risk, so you're gonna get low returns.
Yeah, the only situation where I could see an investor buying a bond is like, let's say I won the lottery, right? And if I win the lottery, I probably don't know too much about investing, because if you're an investor and you know how to assess risk, you know that the lottery is a waste of money. But let's say you win the lottery, right? Then you're not very financially literate, I'm assuming. And that the best situation for that would maybe to be, to put your money into some bonds and live off of the interest rate. Because let's say you win $100 million and you're making like 2-3% interest on the Fed bonds, then that's more than enough income to, survive off of every year. Like, that's one situation. But other than that,
Right.
I mean, yeah. Mahesh,
Yeah,
I think you were gonna say
ultimately,
something.
ultimately it just comes down to personal preference. Like, if you have generally a large amount of money, or you want to put it into things like mutual funds, generally they're going to invest, to kind of diversify your portfolio into stocks as well as bonds. Usually investors with lower value portfolios would not prefer bonds, just because, I mean, they provide very low return for the low risk you're incurring, and it just comes down to personal
Yeah,
preference.
bonds are
to be
more
honest.
like just a means of diversification and a lowering risk when you have larger portfolios. And you don't really see that when you were in a portfolio that has like $5,000 or $10,000, because you don't really need to
Yeah.
diversify into really safe investments.
Exactly. Well, the bonds are obviously more, I think, they're a better deal for the company that issues them. Just because, like I said, the tax write-off that you can make for interest payments, that's the main reason why. And also not giving up ownership. Those are two big pros for if you want to issue debt to finance yourself. That's one reason why bonds may be good as a company. From their perspective, it's a good deal for them. I think better than it is for the investor. The reason, the one place where another place where it might be good for an investor is if it's a recession and your bond doesn't have any default risk. So it's something that's a very high grade corporate bond, let's say, that won't go bankrupt, that makes good on its promises, that type of thing. Then I think it makes sense to get bonds to, I guess, hedge against a recession. But other than that, as an active investment, it doesn't seem very lucrative or smart.
Yeah, and looking back at that company's perspective, like Rutvich mentioned, it's going to be much better than issuing out stock, because in stock you're giving away company ownership in exchange for money, right? To raise money for the company, to do some research, some development, production. But issuing these bonds is pretty much like taking out a loan, which is also really low interest. So it's just a better deal, right? Because investors don't look for high returns on these bonds, and therefore the company doesn't need to pay back much extra on these bonds either. So if they can even increase their production by a little bit, they'll start making enough profit gains to pay back those bonds easily.
Right, that's 100% true. Mahesh, do you want to start on your segment now?
Sure. Yeah. So we were discussing how bonds sometimes you're talking about the yield curve and different types of yields for different bonds, right? So I just want to delve into the topic of bond yield curves. And an interesting thing to note is that so I'll explain what a bond yield curve is in a minute, but before every major recession in the last 50 years, the so-called bond yield curve started inverting, like maybe 6 months to a couple of years before. And it's done so, just to cite some examples, during the recession of 1980, 1990, the dot-com bubble of 2000, and right before the housing crisis of 2008. So now the actual yield curve results from the fact that naturally when you take out a longer bond, interest rates will be higher. Just like when you take out a loan that's a 30-year versus a 15-year, the interest payments on the 30-year would generally be higher. So it makes sense that the longer the loan, the higher the interest rate; the longer the bond, the higher the interest rate. So, however, most bonds aren't usually bought directly from the government or from corporations, like you just said. They are subject to market forces when they're traded in the secondary market through supply and demand. So if there is a higher demand for a certain bond, its price will increase, and likewise, if there's a lower demand, it'll decrease. So supply and demand, simple, right?
Yeah, so bonds might be good for traders just as much as stocks are, but not necessarily for investors. I guess that's the bottom line, right? Because you can still exchange them on a secondary market.
Mm-hmm. So this basic concept still holds. If you purchase a bond for a longer date, you will yield more money because you get that higher interest rate. So that's where the term yield comes from. So if you plot the different types of bonds on the x-axis, so if you go from 2 years to 5 years to 10 years, etc., in normal circumstances, you would expect the yield from each bond to increase with the yield being plotted on the y-axis. So you should end up with a positive sloping line due to the factors I just discussed. But let's say someone has a hunch that maybe in the short term there would be a economic recession. So in that case, all of a sudden a 2-year bond looks a lot less attractive versus a longer term bond like a 10-year bond. And subsequently, the demand for that 2-year bond goes down drastically, lowering the price with it as well. And now so the price of this 2-year bond is now a lot cheaper, which makes the yield based on interest of that bond a lot higher, like Ruvaj mentioned before. So now the yield on the 2-year bonds is higher, and the yield on the 10-year bonds is lower, which is the exact opposite of what it should normally be. So that's when the yield curve starts inversing. And so that's what's been happening before every major recession. And an interesting point to note, like I said before, the yield curve actually started inversing right around August of 2019. So I'm not going to go into any theories, but that's just something interesting to note, how the yield curve started flattening and then inversed around August of 2019. So yeah.
Yeah. Well, I guess I should bring up why the yields increase as you get a longer term bond. I think one reason for that, maybe, the main reason for that is the time value of money and inflation. So bonds always, if you're going to hold for 30 years, obviously the inflation you're going to see throughout that period is going to be more than if you redeem your bond in 2 years, which is one reason. Also, investors are impatient. That's one of the first rules of finance, that people always want more money faster. So yeah, if you get a shorter term bond and the yield on that is higher, that's probably a sign that they're expecting deflation, so economic contraction in the upcoming time period. Yeah.
Yeah, like Rudwood said, I mean, I was gonna mention this earlier, but I'll just later, but I'm just gonna say it now. For everyone, money is gonna be worth more now than it is a year later. If you gave someone $1, would you expect $1 back a year later, or would you expect them to give you more because you had to wait to get your money back? So that same principle stands with bonds. These people are giving money to the companies, and then when they get the money back, they expect more money. And that rate is set before the bond is even exchanged. Same with, and one more thing is inflation. When looking at the idea that $1 today is worth more than $1 next year, you also have to consider that inflation is going to make that dollar worth even less next year. And that goes back to the point where I mentioned the inflation-linked bonds, or the ILBs that the government issues. So that compensates for the inflation on especially like longer bonds, like 10-year, 20-year, that kind of thing.
Yeah. So I guess the inflation to some extent is priced into the bond just due to the fact that longer term bonds are a bit more expensive, but you also have the inflation-backed bonds like Harish just discussed, which I guess amplify that rather than just being priced in due to market forces. So yeah. So I just had one question to end off my little section here. So what do you guys think about the inversion of the yield curve around August of last year? So even without the presence of COVID-19 and the whole pandemic that we're going through, would the economy still have gone into a recession due to other factors? And if so, what do you guys think these factors could possibly be?
We can't say that with absolute certainty, but late last year, a lot of big banks were theorizing that there would be another big recession this year. And then like once, COVID struck, people were like, oh my God, it's a recession. But then, stocks also bouncing back up. So it's kind of an uncertain time. As for looking back at last year, I don't think we saw a lot of telltale causes or telltale signs that there would be a recession upcoming, other than the fact that, yes, you did mention that there was an inversion of the yield curve, which could be a sign, but other than that, I don't think we saw anything.
Well, it could have been a number of things. It could be like tensions in international trade, maybe like rising interest rates, so it wasn't really apparent, besides for obviously the inversion of the yield curve. So my answer is no. I don't think we would have had a recession if COVID did not come.
Yeah. Okay.
Yeah, I think if anyone could predict recessions, they'd probably be paid a lot and working at a hedge fund. So it's kind of hard to say, but I think that in the situation that we did see some weakness around December, I believe, and then we saw another strong gap up rally because of the tech stocks that were leading, and they're still continuing to do pretty well. But I think that we may have had I guess a bit of a slowdown or a correction, but yeah, what we saw during COVID, where the market lost a great big amount of its market cap, I think that probably amplified the effects of what the possible recession or just dip could have been, I guess, right? And but we recovered a strong amount since then, and we may see another drop like we did in 2008 and then again in 2011. So yeah, maybe it's just the recession got delayed, or this was it, what happened because of COVID, and I guess they all got added up together, all the factors came together to cause that recession, and now we're in a recovery state. That's possible as well, but I don't know, maybe it's too uncertain of a market for me to say anything.
Right. Okay.
I mean, even if there are some like characteristics that you see in a recession. We have massive unemployment. Unemployment did decrease from 30 million to 20 million, but 20 million is still like leagues higher than the unemployment rates that we've seen in the past two recessions. So
yeah, it was like 2%.
Yeah, of course.
Before
I think government intervention
COVID started.
might be causing an unstable market where the stock market isn't really reflecting the true state of the economy, because production slowed down, at least for right now, and then people still want to go back into lockdown. So
yeah, we discussed this earlier with the artificial pump and how stock values being misvalued, I think, to some extent, with the amount of capital that's being pumped in. So yeah.
Well, I think tech stocks are being overvalued considering the amount of cash that some of them have, and then manufacturing stocks and that type of thing, like traditional,
are being undervalued.
Yeah, traditional investments are getting seriously lowballed. So maybe it'll be somewhat like the .com bubble, the next correction we have. But again, I can't predict when it'll be. It could be in 2 years. It could be in 2 months. It could be in 2 days. So, I mean, who am I to tell you when the next recession is? I mean, if I had the power to do that, I'd probably be sitting high in some office in Wall Street. But Harish, let's get to your topic.
Yeah. So I mean, I'm just gonna talk a lot about the economy, how these bonds and fixed income securities are gonna show the status of the economy. So like we mentioned before, bonds are some of the most risk-free investments in the United States. Not going to go into other countries because government bonds in other countries might change because government is unstable or something. But in the US, government bonds are thought of to be the risk-free rate, as the US government is likely never going to collapse, and all US bond purchasers will be repaid. So as a result, this risk-free rate can often predict and signal economic struggle and recession. Bond yields are typically lower during times of economic crisis to encourage investors to invest in private companies in order to boost the production of goods and services. Likewise, when an economy is doing great and production is increasing, bond rates are going to be higher just to make bond investments seem more attractive to investors that are going to want to invest in stocks instead. Other fixed income securities include CDs and preferred shares. Bonds, CDs, and preferred shares generally tend to reflect the state of inflation and economic condition, like I said, and they also tend to remain fairly stable, at least in the United States. So I mentioned CD. A CD is a certificate of deposit, and it's usually sold at banks. These CDs have a fixed amount of time until the money is paid back, and a fixed interest rate determined at the time of purchase. Fixed income securities that are meant to be held for longer periods of time obviously have higher interest rates, because like we mentioned, money operates on the principle that for anyone, $1 today is worth more than $1 next year, because people are greedy, and also because of inflation. I did mention IOBs. These inflation-linked bonds issued by the government increase the principal amount invested according to inflation, and then they pay back the purchaser accordingly. So although you might not think of shares when you're thinking of fixed income securities, preferred shares do reflect more on interest rates and inflation rather than company performance. And as a result, they also tend to remain fairly stable, just like other fixed income securities.
They also have a constant dividend rate, not something that changes, which is the case for common stock. So a lot of times when a company grows, they'll change the dividend rate, right, for a common stock. Or if they shrink, then they'll change the dividend rate for a common stock. But for preferred stock, the dividend for preferred stocks always gets paid first, and it's always a constant dividend.
Yeah, and they pay it multiple times a year. And of course, if you buy the stock, dividends may go down, they may go up. But when you buy the preferred share, you're deciding, okay, I want this dividend while I'm holding this. And then, that can go up or down.
And again, these are advantageous to companies and companies that buy preferred shares because of tax write-offs that come with this hybrid security that's a mix of a debt and equity.
Yeah. In addition, these are very low risk because if a company was to go bankrupt, preferred shareholders would be the first ones to get paid back rather than regular stock investors once the company liquidates their assets. Those are the main fixed income securities, and like I said, they do affect the economy. I'm going to end off with a few questions. The audience, you guys think about this, but also guys on the podcast. So other than at times of economic struggle, when do you think that bond real yield rates would increase or decrease?
On the most basic level, right? If you're in an economic boom, bond yield rates, especially in the short term, go down. Recession, they go up. That's simple, but I think it also depends on things like inflation. So, like you guys mentioned, if inflation rates are higher, then bond yield rates would be higher as well.
Yeah.
So yeah.
So that was like the one main thing that I knew. Does anyone else know anything else about when these bond yield rates would decrease or increase, other than due to economic struggle?
Maybe the government was implementing some monetary policy, let's say, like decreasing interest rates for a time or increasing interest rates to somehow boost the economy. That could work, but
so we talked about interest rates already. So I think other than that, the main force that people often overlook is if you're in the middle of a war, which is when governments really encourage you to buy bonds. So it depends a lot on foreign policy and foreign affairs, that type of thing for governments, and to a certain degree for companies as well, because during those times, I think a lot of private investment is put into defense and that type of thing that helps during a time of crisis.
Yeah, Rudish, you brought up a really good point. During these times of war, the government needs a lot of money to spend on defense. They need to pay money to these defense contractors, and they don't just want to increase tax on everyone by 50%. So rather, making these bonds available to everyone gets them a lot of money right then, and then once they win the war and have mixed economic results, they can pay them back later. So the second question,
the
I
economic
have is,
results of war. I'd like to bring that up for just a second. I think they're very controversial. A lot of people say that it brings in a boom for manufacturing, innovation, that type of thing. But again, it's also artificially spurred. So a lot of that investment doesn't really get any attention, right? Sure, you develop a lot of stuff, but there wasn't any demand on it. The government demand is now gone after the war. So it's kind of like a bubble that's created. It's a very small bubble, and it depends on how long the war goes on. But it also, obviously, it kills people, and war is terrible. So there's that as well.
A lot of times we see the government intervene. It's usually to artificially make the economy go better, rather than just letting the free market play out. Moving on to the second question that I had. In times of economic uncertainty, would you personally turn to fixed income securities or commodities to provide a stable investment, and why?
Well, I think obviously
Go ahead, man.
Well, I would say I mean, in terms of like a basic investment, right? Like buying a stock. I mean, obviously, in a time of economic uncertainty, I wouldn't do that. But then you could also invest in terms of like shorting a stock or buying put options or something like that. But usually, most high profile like investors would flock towards bonds in terms of economic uncertainty, just because 10 years down the line, if they purchase a 10-year bond option, if they think um, if it's currently a time of economic uncertainty, they'll be getting that regular interest payment for the next 10 years through that entire economic recession. So yeah, Rubens, you can go ahead.
Well, so I'd say, depending on how skilled of a trader I am and where my business acumen lies, I might buy commodities. So if you're thinking of like oil, that type of thing, you could probably get like a forward contract that's, I don't know, 2 years from now, when you believe that travel and everything will go back to normal, then probably, oil prices might go up to 100. It's quite a possibility because of the amount of oil, like I said before, in I think the first episode, OPEC is limiting the amount of oil that's being drilled. So it might go in the entire other direction, where now oil is way more expensive because nobody was making it and all the operations were shut down. So now there's a limited supply because there was no demand before. But then when the demand does spike up, let's say when the vaccine is deployed, then it could probably take the oil prices to even more than they were before. So yeah, I guess maybe commodities would be a good choice, but it depends on what type of recession and economic uncertainty there is.
Yeah, I think if you're skilled enough of an investor, you'll be able to play the actual recession for your benefit. So it's not necessarily that you would flock towards bonds. It really comes down to, I think, skill and preference and risk tolerance.
I mean, like what type of thing, what type of commodity or what type of investment you want to make is solely dependent on your financial situation. So if I wasn't desperate for money, and but like I'm in need of it down the road, it would depend on my personal financial situation. Um, so if I'm in not in desperate need of money, um, and um, but need money, some money down the road, I would make a bond investment. But again, what type of investment you want to make is solely based on your personal decisions and your personal financial situation. So obviously, like I wouldn't invest in a stock during a recession unless I was really desperate for money. But yeah, I would go more towards the low risk investments during a recession because I have a better guarantee that I'm not going to lose my money.
There's some pretty good answers on both sides for us, fixed income securities and commodities. It's like you said, it's a lot based on personal preference and on the type of recession and how much money you have to invest, that kind of things. So if we have no other answers, then
The best answer, though, the best answer would be to diversify. It would be to have both bonds and futures contracts for oil, because
Right.
in any situation, diversification works to both ends usually, and also because depending on how much timing you borrow, like how much time you have for your forward contract or for your stocks that you're willing to hold, or for your options or whatever security that you're using to try and quote unquote beat the market. Um, if you diversify that along with a low risk security, then I think you'd be better off than any of the two options. And that's just basic like portfolio theory.
Yeah, diversification is really important. And I think
Yeah, so Raghav,
Raghav will
do you
be
wanna?
speaking next.
So so basically to end it all off, I'm just gonna after throwing around all these complicated terms and stuff, I'm just gonna slow it down a bit, cover the extreme basics, and cover what type of risk you can incur as a bondholder. Right? So bonds are usually thrown out when a company wants to finance a new project, like let's say a $5 million factory. They could do it in two ways. One, they could issue more shares to grow their equity, which in turn can be used to finance assets such as their factories or their land. Two, they could take out a loan to finance those assets. So how does a company pay this loan back? This is when the bonds come in. They issued a fixed type of they issue a type of fixed income security called a bond. So bonds are usually tickets which ask the holder to pay a company X amount of money, and for the maturity time, let's say Y amount of years, the bond issuer pays the holder Z% interest on the X amount of money every year until the Y amount of years has passed. The bond issuer also has to pay the original amount of loan back. So I want you guys to remember this statement, and this is a very important statement. Bonds are safer than stock, but this does not mean they come without risk. So, speaking on risk, there's usually 4 main types of risk you could incur as a bondholder. Number 1, there's interest rate risk. If interest rates go up, the value of the bond goes down. If interest rates go down, the value of the bond goes up. So basically, they have an inverse relationship. So I'm going to bring up an example here. If you have a bond with the 10% interest at $10,000 and interest rates go down to, let's say, 8%, that would mean investor looking to make $1,000 interest per year on the bond would have to spend $12,500, meaning you could sell your bond for more if interest rates went down. Likewise, if interest rates went up, that would mean your bond would be worthless, not worthless, as people would have to spend less to make the $1,000 interest per year. So that's known as interest rate risk. That's just a basic surface definition. And I wanted to point out, if the longer the maturity of the bond, the higher volatility risk, obviously, because if you hold a bond for a longer amount of time, there's more room for interest rates to fall, interest rates to rise. So typically, if you're looking to really sell your bond and really make a quick buck, you would do it when the interest rates go down. That way you can sell your bond for more on the open market. Their companies.
So yeah.
Their companies. Yeah, go ahead, Mahesh.
Yeah, I just wanted to bring up 2 things actually. So first, when you brought up the fact that, or when you hypothesized, I guess, that wait, hold up.
Mark the time.
Mark time.
Yeah.
Right.
Oh, also, I was thinking for the clips, we could just let's trim out just the part where we ask the question, like
Oh, sure.
2 or 3 of the
Those
best
are like
questions,
the hot parts, I guess.
and then
Okay.
and then if people want to see the reasoning behind the answers, then they can come watch when we talk about what it is.
So you talked about how bonds are usually less risky than stock, but they don't come without risk. And so I think the term risk-free rate is kind of misleading, just because when you bring up the fact of all bonds, it doesn't necessarily apply, because with government bonds, yes, of course, they're almost risk-free and you can pretty much expect a complete return on your money. But with corporate bonds especially, you have a higher default risk, and that default risk increases if the balance sheet isn't good, or they have a negative EPS or a smaller market cap and stuff like that. The second thing I wanted to bring up is that usually you said how longer maturity usually has high risk, and I just wanted to say in exchange for that risk, you get paid a higher interest rate.
Yeah,
so that's
how high risk, high return, right? Higher volatility should be the proper term. So there are these special agencies called credit rating agencies, which rate the default risk of the bond using letters like AAA, AA, A, like that, and you can find those online. I'd say they're a pretty good tool when trying to invest in a bond. There is 2 more risks I want to talk about. One is inflation risk. So when inflation goes up, the purchasing power goes down of money, obviously, right? So investors lose money on an investment because the interest rate isn't going to be worth as much. Interest rates are usually adjusted to match inflation rates to limit inflation risk exposure. And the final risk I want to get onto is called call risk. That's when the bond issuers basically call back the bond, meaning you lose the rest of the interest rates you were going to get paid and the lump sum of the money. I'd say that would actually be worse than default risk, because at least maybe in default risk, you could get paid your interest, just not your lump sum of money. In call risk, they could call it back, and then you'd be left with loss of interest and loss of lump sum payment. So, what
I just want to clarify the
Yeah.
lump sum that we keep mentioning. I just want to make sure that our audience understands. It's the principal payment that you buy the bond for.
So, that's basically I had a short section today. So, if you guys want to bring anything up, feel free to discuss that. I've asked my questions for today.
Thank you everyone for tuning into the third episode of the Dogs of the Law Street. We hope to see you here again when we discuss our next topic. We will be releasing new episodes every Friday. Follow our Instagram at the Law Street Podcast for updates and exclusive content. If you have any business comments or inquiries, please email them to thelawstreetpodcast@gmail.com. Next week we will be discussing derivatives. Have a great rest of your day.
All right, 3, 2, 1, stop.